What if I told you that your dividend ETF investment could either sink or soar during a trade war? Hey there, it's Harry here, and in today's video, I'm diving deep into something that could make or break your dividend portfolio in the current economic climate: tariffs. On April 2, 2025, President Trump announced sweeping new import tariffs that sent markets into a tailspin. While some ETFs plummeted, others showed remarkable resilience. Today, I'll reveal exactly how three major dividend ETFs, SCHD, JEPQ, and VYM, performed during trade wars, and which one could potentially double your returns in this environment. Here's the problem most dividend investors face right now. With Trump imposing a baseline 10% duty on all U.S. imports and much steeper rates for major partners like China, 34%, EU, 20%, and Japan, 24%, we're looking at tariff levels not seen since 1910. Many investors are panicking, dumping their stocks without understanding how different dividend ETFs actually respond to trade tensions. They don't realize that the sector composition of their ETF could mean the difference between devastating losses and remarkable stability. Look at what happened immediately after the tariff announcement. Apple plunged 7%, wiping out $240 billion in market cap, while Nvidia dropped 5.6%, losing $153 billion. S&P futures fell about 3%, and the Dow was projected to drop 1,000 points at open. But here's what most investors missed. Not all dividend ETFs reacted the same way. The solution is understanding which dividend ETFs are positioned to weather, or even thrive in, a tariff environment. By analyzing these three popular dividend ETFs, SCHD, JEPQ, and VYM, we can see dramatic differences in how they respond to trade tensions. SCHD, the Schwab U.S. Dividend Equity ETF, currently yields 3.74% and holds quality companies with minimal tech exposure. JEPQ, the JPMorgan Nasdaq Equity Premium Income ETF, boasts an impressive 10.99% yield but is heavily invested in tech. And VYM, Vanguard's High Dividend Yield ETF, offers a 3.03% yield with a focus on established dividend payers. Each has a completely different sector composition, which becomes crucial during trade wars. Let me break down why this matters so much. Now let's look at exactly why these ETFs behave so differently during tariff situations. It all comes down to sector allocation and holdings. First, let's examine SCHD. SCHD's top holdings include AbbVie, 4.75%, Coca-Cola, 4.66%, and Amgen, 4.49%. Notice what's missing: big tech names like Apple, Microsoft, or Nvidia. SCHD's sector breakdown reveals why it's relatively insulated from tariff shocks. It has financials, 17.82%, healthcare, 17.66%, consumer defensive, 14.91%, energy, 11.86%, industrials, 10.73%, technology, just 10.59%. This sector composition is precisely why SCHD didn't tank as badly as tech-heavy funds when tariffs were announced. It dropped only about 3.13% compared to the broader market decline of 3.4%. Now let's contrast that with JEPQ. Looking at JEPQ's holdings, you immediately see the issue: Apple, 7.81%, Nvidia, 6.74%, Microsoft, 6.39%, and Amazon, 5.02%, make up its largest positions. These are exactly the companies most vulnerable to tariff impacts. JEPQ's sector allocation is heavily skewed toward information technology, 50.25%, communication services, 15.96%, consumer discretionary, 14.55%. No wonder JEPQ plummeted 3.82% on the tariff news. Over 80% of its portfolio is in sectors directly affected by trade tensions. Finally, let's look at VYM. Its top holdings include Broadcom, 4.94%, JPMorgan Chase, 4.05%, and ExxonMobil, 2.72%. Similar to SCHD, it avoids heavy concentration in pure tech names. VYM's sector breakdown shows financial services, 23.02%, technology, 13.06%, consumer defensive, 12.90%, healthcare, 12.02%, industrials, 10.70%, This balanced approach helped VYM decline only about 3.08% after the tariff announcement. Better than tech-focused funds, but still significant. Let me walk you through what this means for Harry, our example investor. If Harry had $10,000 invested in each of these ETFs before the tariff announcement, investment would have dropped to about $9,687. His JEPQ investment would have fallen to around $9,618. His VYM investment would have decreased to approximately $9,692. But here's where it gets really interesting. If we look at how these ETFs performed during previous trade tensions under the first Trump administration, 2018-2020, we see a clear pattern emerging. Investment strategy breakdown. So how should you incorporate these dividend ETFs into your portfolio, given what we now know about their tariff sensitivity? Let me break down 3 strategic approaches. Strategy Arc 1. The defensive dividend approach. If you believe tariffs will persist or escalate, consider making SCHD your core dividend holding, 50-60% of your dividend allocation. Its lower exposure to multinational tech and higher allocation to domestic-focused sectors like healthcare, consumer staples, and utilities provides natural insulation from trade tensions. For Harry, this would mean allocating about $60,000 of a $100,000 dividend portfolio to SCHD. With its 3.74% yield, that's generating about $2,244 in annual dividend income with less downside risk during trade wars. Strategy Docker 2. The high income approach. If maximizing current income is your priority despite volatility, JEPQ still has a place in your portfolio, just a smaller one during trade tensions. Consider a 20-30% allocation to capture that impressive 10.99% yield. For Harry, a $20,000 allocation to JEPQ would generate about $2,198 in annual income, almost as much as his $60,000 SCHD position. However, he should expect higher volatility and potentially deeper drawdowns if trade tensions escalate. Strategy Eiger 3. The balanced value approach. VYM offers a middle ground approach with its 3.03% yield and balanced sector exposure. It could make up 20-30% of your dividend allocation, providing diversification across dividend-paying blue chips with moderate tariff exposure. For Harry, a $20,000 position in VYM would generate about $606 in annual income with moderate volatility during trade wars. Now, let's talk about timing. Should you adjust these allocations based on trade war headlines? Generally, no. Market timing is notoriously difficult. Instead, consider a dollar-cost averaging approach during periods of tariff-induced volatility, perhaps increasing your investment in SCHD during significant dips. Comparative analysis. Let's directly compare these ETFs across several key metrics relevant to tariff scenarios. Expense ratio. SCHD, 0.06%. JEPQ, 0.35%. VYM, 0.06%. Both SCHD and VYM offer rock-bottom fees, while JEPQ charges more for its active management and options strategy. Dividend yield. SCHD, 3.74%. JEPQ, 10.99%. VYM, 3.03%. JEPQ's yield is outstanding, but remember this comes from option premiums, not just dividends. Tech exposure, percent in information technology. SCHD, 10.59%. JEPQ, 50.25%. VYM, 13.06%. This is perhaps the most crucial metric during trade wars. JEPQ's massive tech concentration makes it vulnerable, while SCHD and VYM have minimal exposure. Financial defensive sectors. Percent in financials, healthcare, utilities, consumer staples. SCHD 50%, JEPQ 13%, VYM 48%. Both SCHD and VYM have approximately half their portfolios in sectors that are historically more resilient during trade tensions. YTD performance as of April 2, 2025. SCHD plus 2.93%, JEPQ 5.43%, VYM plus 2.11%. Even before the latest tariff announcement, SCHD and VYM were outperforming JEPQ, suggesting the market was already rotating toward value and away from growth. 5-year performance. SCHD, 14.66%. JEPQ, NA, launched in 2022. VYM, 13.71%. Over longer time frames, both SCHD and VYM have delivered solid returns, with SCHD slightly outperforming. Numerical examples showing returns. Let's look at some specific numerical examples to see how these ETFs might perform in different tariff scenarios. Scenario 1. Prolonged trade war, similar to 2018-2019. Let's say Harry invests $10,000 in each ETF at the start of a prolonged trade conflict. Based on historical patterns during previous trade tensions. SCH $100, 8% return. Year 2. Grows to approximately $11,664, 8% return. Year 3. Grows to approximately $12,597, 8% return. With dividends reinvested, 3.74% yield. Total after 3 years, $13,200. JEPQ. Year 1, $10,000 drops to approximately $9,500, 5% return. Year 2. Recovers to approximately $10,450, 10% return. Year 3. Grows to approximately $11,495, 10% return. With distributions reinvested, 10.99% yield. Total after 3 years, $13,800. VYM. Year 1. $10,000 grows to approximately $10,600, 6% return. Year 2. Grows to approximately $11,236, 6% return. Year 3. Grows to approximately $11,910, 6% return. With dividends reinvested, 3.03% yield. Total after 3 years, $12,900. Scenario 2. Short-term trade. Tensions. Followed by resolution. In this scenario, tariffs create 6 months of volatility before a resolution. SCHD. Initial 6 months, $10,000 drops to $9,700, 3%. Next 6 months after resolution, recovers to $10,670, 10% bounce. With dividend, then $10,850 after 1 year. JEPQ. Initial 6 months, $10,000 drops to $8,800, 12%. Next 6 months after resolution, recovers to $10,560, 20% bounce. With distribution, $11,600 after 1 year. VYM. Initial 6 months, $10,000. Drops to $9,800, 2%. Next 6 months after resolution, recovers to $10,584, 8% bounce. With dividend, $10,880 after 1 year. But what about longer time frames? Let's look at a 30-year projection for Harry's $10,000 investment in each ETF, assuming historical growth rates and dividend reinvestment. SCHD, 8.5% price appreciation, plus 3.74% dividend yield reinvested. After 10 years, $32,000. After 20 years, $104,000. After 30 years, $320,000. JEPQ, 7% price appreciation, plus 10.99% dividend yield reinvested. After 10 years, $47,000. After 20 years, $220,000. After 30 years, $1,020,000. VYM, 7% price appreciation, plus 3.03% dividend yield reinvested. After 10 years, $27,000. After 20 years, $73,000. After 30 years, $200,000. These projections assume consistent performance, which is unlikely, but they illustrate the power of dividend reinvestment over time, especially with JEPQ's high yield if it can maintain it through trade tensions. So, what's the bottom line for dividend investors facing tariff uncertainty? First, sector exposure matters enormously during trade wars. SCHD and VYM, with their lower technology allocations and higher weights in defensive sectors, are naturally more insulated from tariff shocks than tech-heavy funds like JEPQ. Second, yield isn't everything. While JEPQ's 10.99% yield is eye-popping, it comes with significantly higher volatility during trade tensions. SCHD's more modest 3.74% yield may actually deliver better risk-adjusted returns in a prolonged trade war. Third, a balanced approach combining these ETFs may be optimal. Consider a core position in SCHD, 50-60%, supplemented by smaller allocations to JEPQ at 20-30% and VYM 20-30% to balance income, growth, and protection against trade tensions. Remember that tariff situations are fluid. While current tariff levels are at historic highs, negotiations could lead to reductions. Stay informed, but avoid making panic moves based on headlines. If you found this analysis helpful, make sure to hit that subscribe button for more dividend investing insights. Drop a comment below sharing which dividend ETF you think will perform best during the current tariff situation: SCHD, JEPQ, or VYM. I'd love to hear your thoughts.